Every time someone takes on debt, the economy grows. That sounds backward. We're told debt is dangerous, something to avoid, something that traps people, ruins lives, creates crises. And yet, the entire modern economy depends on it. Not just a little, completely. Right now, governments are drowning in debt. Companies are built on it. Consumers rely on it. And the global financial system keeps expanding because of it. So here's the uncomfortable truth. If everyone suddenly paid off their debt, the economy wouldn't boom. It would shrink fast. And that raises a strange question. If debt is so risky, why does everything depend on it? To understand that, you have to start with something most people never see, where money actually comes from. Most people assume money is created by governments, printed, issued, controlled. That's only partially true. In modern economies, most money is created when banks make loans, not before, at the moment of lending. Let's slow that down. You walk into a bank and take a loan for a house, a business, a car. The bank doesn't pull that money from a vault and hand it to you. It creates it digitally, out of nothing. Your loan becomes an asset for the bank, and your deposit becomes new money in the system. In that moment, the money supply expands, not because someone saved more, but because someone borrowed. That's the first key idea. Debt doesn't just use money, it creates it. Now scale that up. Millions of loans, mortgages, business credit, government bonds, each one adding new money into circulation. This is why credit growth and economic growth are so tightly connected. When borrowing rises, the economy expands. When borrowing slows, things start to stall. And when borrowing collapses, that's when crises happen. You've seen it before. The housing crash, the financial crisis, credit freezes. Suddenly, banks stop lending. People stop borrowing. Money stops being created. And the system tightens. Not gradually, violently, because if debt creates money, then less debt means less money. And less money means less spending, less investment, less growth. This is why central banks panic during downturns. They cut interest rates. They inject liquidity. They try to restart borrowing. Because without debt, the system doesn't just slow down, it contracts. Now, here's where it gets more interesting. Debt doesn't just create money, it pulls the future into the present. When you take a loan, you're spending money you haven't earned yet. You're accelerating consumption. Instead of waiting years to save, you act now, buy now, build now, expand now. And that creates economic activity immediately. A house gets built, a business hires workers, a company invests in growth, all funded by future income used today. This is the second layer. Debt speeds up time. It compresses the future into the present. And when millions of people and institutions do this at once, the economy feels like it's accelerating. Growth looks strong. Demand looks high. Everything feels like it's moving forward. But there's a catch. That future still has to arrive because every loan comes with an obligation, repayment, with interest, which means tomorrow's income is already spoken for. The more debt you take on today, the more of your future is locked in. Now imagine this across an entire economy. Households with mortgages, students with loans, companies with debt, governments running deficits year after year, everyone borrowing from the future to sustain the present. It works until it doesn't, because at some point the system runs into a limit, not a hard stop, but a tension. As debt grows, so do repayments. As repayments grow, they start to eat into spending. And when enough income is redirected towards servicing debt instead of creating new demand, growth begins to slow. This is the third layer. Debt drives growth, but also sets its boundaries. Too little debt and the economy stalls. Too much debt and the system becomes fragile. So policymakers walk a tightrope. Encourage borrowing, but not too much. Support growth, but avoid collapse. And this is where interest rates come in. Interest rates are the price of borrowing. Lower them and debt becomes cheaper. People borrow more. Money expands, growth accelerates, raise them and borrowing slows. The system cools down. But here's the problem. Over time, the system becomes addicted to low rates because as debt levels rise, even small increases in interest rates can cause stress. Higher payments, tighter cash flow, more defaults. So central banks face a dilemma, keep rates low, and risk inflation, asset bubbles, and long-term instability, or raise rates and risk slowing the entire economy. There's no easy option. Now, let's talk about something most people don't connect to debt. Asset prices. When borrowing is cheap and money is expanding, where does that money go? Not evenly. A lot of it flows into assets, real estate, stocks, financial markets. People borrow to buy these assets. Prices go up. As prices go up, the value of collateral increases, which allows for more borrowing, which pushes prices even higher. It becomes a loop. Debt fuels asset growth supports more debt, and this creates the appearance of wealth. Portfolios rise, property values increase, balance sheets look stronger, but much of that growth is tied to the expansion of credit, not just underlying productivity. This is where things start to feel a little disconnected, because the real economy, wages, production, everyday spending, doesn't always keep up. So you get a strange situation, asset prices booming, while many people feel like they're standing still. And it all traces back to how debt flows through the system. Now, zoom out even further. Governments. Modern governments don't operate like households. They don't need to balance budgets year to year. They run deficits, which means they spend more than they collect in taxes. And how do they cover that gap? They borrow, issuing bonds, adding to national debt, and as long as the economy grows and interest rates stay manageable, this system can continue. But the scale matters. Global debt today isn't small. It's massive, trillions upon trillions, and growing, which raises another uncomfortable reality. The system doesn't just allow debt, it requires it. If borrowing slows too much, growth weakens. If growth weakens, debt becomes harder to service. If debt becomes harder to service, risk increases. So the system pushes toward more borrowing, not less, which is why you hear phrases like stimulus, liquidity, supporting demand. These are all ways of keeping the debt engine running, because turning it off isn't really an option. Now, this doesn't mean the system is broken, but it does mean it has a direction. It leans toward expansion, toward credit, toward pulling more of the future into the present. And that creates a long-term question. What happens when the future arrives? When debts accumulate faster than the income needed to support them? When growth slows but obligations remain? Historically, systems like this adjust in a few ways: inflation, growth, restructuring, or crisis. Sometimes quietly, sometimes all at once, but always in response to the same underlying tension: too much debt, chasing not enough real growth. And yet, despite all of this, the system keeps going, because in the short term, it works. It builds, it expands, it creates a sense of progress. The real question isn't whether debt is good or bad. It's this: if debt is the engine of the modern economy, what happens when that engine can't speed up anymore? And more importantly, what happens when it can't slow down either? If you found this useful, subscribe to the channel and like the video so you don't miss what comes next.